You hit $1 million in your 401k. You feel set. Then you turn 73, and the IRS sends you a letter telling you exactly how much you have to withdraw this year. Not advice. A requirement, and the bill that comes with it is bigger than anyone warned you about. For 30 years, the deal sounded simple. Skip the tax now. Pay it later when you're retired and your income is lower. That is the promise of a traditional 401k and a traditional IRA. Save tax deferred. Pull it out at a lower rate. But retired does not mean lower income. Not if you actually did what you were supposed to do. $1 million 401k is the lower bracket promise breaking in slow motion. You did not fail. The numbers got too big. This is the part nobody draws on the whiteboard when you sign up. When you turn 73, the IRS forces you to start pulling money out of every traditional retirement account you own. Not when you need it. Not when it makes tax sense. On their schedule, they call it the Required Minimum Distribution, the RMD. The math is built into a single table. You take your account balance on December 31st. You divide by a life expectancy number that shrinks every year. At 73, the divisor is 26.5. At 80, it is 20.2. At 85, it is 16. Smaller divisor, bigger required withdrawal. $1 million 401k at 73 forces about $37,700 out the door in year one. Same account at 80, even if you barely touched it, forces around $49,500. And most accounts keep growing during these years, even while you spend them. The required amount climbs faster than you draw it down. Now stack Social Security on top. A typical couple at 65 collects around $52,000 in benefits a year. Add that to the RMD and your taxable income is north of $90,000 before you choose a single dollar of vacation spending. That income does three things in the background. Quietly. First, your Social Security becomes taxable, up to 85% of it. The dollar you earned in 1995 is now triggering a tax on the dollar Social Security is paying you today. Second, your real marginal rate jumps, not 22%, closer to 40%, because every new dollar of RMD also drags a dollar of Social Security into the taxable pile right behind it. Financial planners have a name for this effect, the Tax Torpedo. Third, you cross the RMA threshold for Medicare. $106,000 of income, single filer, $1 over the line, and your Medicare Part B premium roughly doubles. That is not a tax on paper. It functions exactly like one in your bank account. So the lower bracket retirement was just a story. The actual effective rate sits closer to what you paid while you were working. Sometimes higher. Welcome to the Deferral Bill. Now run 3 lives. Same person, same career, same savings, different tax plan. First life. You saved $1.5 million in a traditional 401k by 65. You take Social Security at 67. By 73, your RMD is roughly $57,000, plus $40,000 of benefits, mostly taxable. That is $97,000 of ordinary income before you spend anything. Federal tax bill around $12,000. State bill, depending on where you live, another $4,000 to $7,000. IRMA surcharge on top, around $2,100 a year. Total bite, year one, close to $20,000. Now run that across 20 years of retirement, with balances that compound between withdrawals. Cumulative tax bill from that one 401k, north of $300,000. You saved $1.5 million. You will hand a fifth of it back, second life. Same starting balance. But somewhere in your 50s, somebody told you about Roth conversions. So during the quiet window between when you stopped working full-time and when you turned 73, you slowly moved $400,000 from your traditional 401k into a Roth IRA. You paid tax on the conversion at 24%. Now, at 73, your traditional balance is closer to $1.1 million. Your RMD is smaller. Your Social Security mostly stays under the torpedo. IRMA does not trigger. your effective rate drops by about a third. Net, you came out around $60,000 ahead, and your kids come out far ahead of that because Roth dollars pass to them tax-free. Third life, same person. But somebody told you the truth in your 40s. Half your retirement money went into a traditional account. Half went into a Roth, half tax deferred, half tax paid. By 73, your RMD is on a $750,000 base, not $1.5 million. You pull what you need from each side. Your taxable income lives in a moderate bracket on purpose. Social Security stays mostly clear of the torpedo. ERMI A does not trigger. Your effective rate is maybe 14%, not 25%. You don't need to convert at 60. You don't need to scramble. You already paid. Same dollars saved. 3 completely different retirements. The variable was never the balance. The variable was the bucket. Here is what the math is really telling you. It is not a tax. It is a payment plan. A traditional 401k is a loan from the IRS mess to your past self, and the bill comes due on a schedule the IRS picks. The longer you delay, the more interest stacks inside the balance, and that interest is taxed too when it leaves. The deferral bill compounds right alongside your balance. That is why people who clearly won the game still feel like they are losing it after 73. They did everything right. They got the match, they maxed it out, they watched it compound for 30 years, and nobody told them that compounding works on the tax bill too. It is not bad planning, it is a system built around an assumption that quietly broke for anyone who earned good money. The assumption was that your retirement income would be lower than your working income. For a household earning $150,000 or more during your career and saving aggressively into a traditional plan, that assumption does not hold. Your 401k won, which means the IRS is about to win right behind it. 3 things to do tonight. Pull up your 401k balance. Multiply it by 4%. That is roughly your first RMD in today's dollars when you turn 73. Add it to your projected Social Security. That is your taxable income at 73 before you spend one discretionary dollar. Second, log into your plan. Check whether it offers a Roth 401k option. Most do. Toggle a slice of next year's contribution to Roth. Even 25% of new money changes the long-term math. Third, write Roth conversion window on the line of your retirement plan for ages 60 through 72. That is your one chance to move money out of the deferred bucket at a rate you choose, not a rate they choose. The bill is coming either way. The only question is, who sets the pace? If you found this useful, hit like, subscribe, and turn on notifications for more simple explanations.